What a time in the markets. We had an October Fed meeting with limited data available, and both equities and fixed income rallies continue. So what's next for credit markets as we approach year end? And with mortgage rates at their lowest in a year, will high quality bonds remain in favor? We're going to talk about that and more with Leslie Falconio right now on UBS Trending. Hi, everyone, and thank you so much for joining me. I'm Anthony Pastore, and this is UBS Trending, and Leslie Falconio is back in the studio with me. Leslie, thanks for dropping by.
Thanks for having me.
Of course. So I want to get right to the big story, which is the Fed meeting that just took place this past week. We had the meeting. The Fed did cut 25 basis points, which was widely expected. However, there was limited data available because of the government shutdown. We didn't get jobs data recently. We may not get it again for next month, depending on what happens. Where do you see the Fed kind of going as we move towards the end of the year? Because Powell himself in his press conference said that a cut in December is not a quote-unquote foregone conclusion. So what do you think he meant by that?
And I think that is the key of what you just said. That statement that December is not a foregone conclusion, not just in the Q&A, but actually was his written script, was really what the market had focused on. Because you're absolutely right. The market anticipated 25 basis points cut, in the October meeting. But prior to, they had 100%, close to 100% probability of a cut in December. Mm-hmm. When that statement came out, right, and he made this, it's not a foregone conclusion, you saw a really big shift in sentiment. They lowered that probability of a December cut down to from, like, say, 98% down to 60% probability. We saw the market back up a bit. We saw that short end yields move higher as they start to be, wait a minute, maybe not, the Fed is not as dovish. And I just want to say, Anthony, when I was here the last time, we talked about the fact that during the September FOMC, when the market really became very dovish, pricing in a lot of cuts through 2026, we took some interest rate risk off the table. We'd gotten to that the 4% 10-year Treasury yield, actually a little bit through that level, which was our year-end forecast. And we took the opportunity at that point in time to say, okay, the market is pricing in a lot of cuts, in a short period of time, right? So we thought, okay, we'll take some interest rate risk off. Now, we think about yesterday, and to your point, the Fed doesn't have a lot of data to go by, right? And when you don't have a lot of data to go by, as he said this, it's like driving in the fog. And when you drive in the fog, you don't want to hit the gas, right? You might want to be a bit more cautious. With that said, we still feel they cut in December for 25, right? We still have that on table. Maybe if in fact we get some sort of, shock in sort of the CPI that we're getting, which is very backward looking, then it might change, but we still expect them to cut in December. We are looking for, probably about 1 or 2 more cuts, as we head into 2026. But again, the cloudedness of the data, the uncertainty in terms of what's going on, and more importantly, the dislocation, if you will, amongst Fed members, right? We had 2 dissents yesterday, and that was the first time since 2019 you had a hawkish and a dovish dissent. So there's still a lot of uncertainty within the committee members themselves in terms of really what could happen in December.
It's interesting because you bring up inflation. We saw CPI recently come in about 3%, and the Fed funds ultimate target of inflation is 2%. But if inflation is sitting at 3%, doesn't that sort of make the real Fed funds rate or the real rate more like close to 4%, exactly where the 10-year Treasury is sitting?
Well, it is. I think that with that 10-year Treasury, again, we're looking for around that 4%, maybe 3.75 at some point in 2026, but not a straight line because, again, we took some interest rate risk off the table. The difficulty with the CPI data, like we've seen this housing services come down, owner's equivalent rent came down in the last CPI data, but that was also from an elevated number. And it's, again, backward looking. But still, when you look overall, really what that number did in CPI, it just didn't come in as high as what the market was expecting.
That's right.
But it's still up.
It's still up.
So you're still elevated.
Yes.
And I think that's really what, people are paying attention to. And until we still see this, inflation start to come down, to know that the relief, there isn't any tariff type effect on the inflation, you'll probably have this push me, pull me from the Fed committee.
Yeah, I was going to say, because what Powell even specified, that there was some dissension between labor mandates and also inflation amongst the members. There's differing views. So that's, I think, another reason why he said the foregone conclusion words in the statement and in the press conference. So interesting to see where we might be heading as we get closer to December. Let's talk about this, I guess you're calling it an everything everything rally. I mean, we all know that equities are up. A lot of that is the artificial intelligence trade, et cetera. But bonds are also up. I mean, it's just been such an interesting time. So when you look at sort of the credit side of the market, where do you see? Are there opportunities there? I mean, spreads are so tight right now. What do you see? What are you seeing when you look at sort of like the table of opportunity in front of you?
Listen, the opportunity set, there's no question, is not wide.
Yeah,
I would
right.
say the opportunity set's relatively narrow. But to your point, and you're absolutely right. I mean, spreads coming into the year weren't very wide. And the reason why they weren't is we know we had, this sweep in terms of the election. We had this U.S. exceptionalism, tax cuts, growth. So everyone was like, so all of this was priced in even prior to the start of the year. So since that time, we had that pocket of vulnerability in April. We've had spreads come in. Listen, I mean, fixed income is up anywhere from 3 to 9% across the board. So, we've had obviously interest rates come down from that 480 high or 485 high we saw in January down to around that 390 level. So part of this, of course, is price appreciation from yields falling. We've had spreads compress a little bit, not a tremendous amount, but the driver has been carry, yield, compounding income, and the ability for investors to move from cash into that compounding income has really been that, tailwind to total return. So that's been part of that everything rally. Obviously, sectors that have a higher correlation to the equity market, such as high yield, even a little bit of IG, are also obviously doing well, as the equity market has shown incredible resilience, throughout the entire year.
And overall return is essentially the same when you're looking at the different, if we look at the different coupon spreads, and if you're looking, essentially, and you can explain this better as the expert, the situation when you have those tight spreads and the coupon spreads the way they are, the market environment is where investors are not really being that picky about where they're getting their, I guess, the spread from.
Right.
Right?
And
I mean, that's the environment that we're sitting in right now.
It is. And I mean, I think to your point, that's one of the reasons why we don't. Listen, it's not like we think the higher credit embedded sectors are going to fall off a cliff.
Okay.
There's no question. We're not looking for some kind of catalyst. We just think they're tight, right? We just don't think you're getting a lot of cushion for going into that, sort of credit, that, lower credit embedded sectors. That's why we like the high quality, IG corporates, agency MBS. Those are the ones that we really feel will have the tailwind to total return. Not huge spreads, but you have a lot of protection against, just in case we have these little pockets of vulnerability along the way, and particularly as we head into the end of the year.
Right. Well, that's an interesting point. You bring up high quality. You talked about agency mortgage-backed securities, which, of course, we've talked about many times here. But we're seeing this 30-year mortgage rate, on average, continue to come down. I mean, it's at its lowest in a year. We went from something like 8% a year ago. Now it's about 6.2%. So how does that impact where you see the opportunities within high quality and those agency mortgage-backed securities that you like so much?
Yeah, I mean, we've talked about this, Anthony, you and I, several times.
Yes.
Because when people think about the mortgage rate, they look at the 10-year Treasury yield, which obviously is a driver of the 30-year mortgage rate. But it's not the only driver, right? One of the, a large contributor as well is that what we call that spread of the current coupon spread of the, 30-year agency MBS. We've seen the spread recently compress quite dramatically after lagging for a long period of time. So if you think about what you just said, we're at about a 6.20, 30-year mortgage rate. I've got 4%-ish 10-year Treasury yields. How do I get that mortgage rate to move lower?
That's right.
To actually start to fuel the housing market to say, people have 5.5 at that level? It's probably not going to come from, where I see it difficult come from the decline in 10-year Treasury yields. It's going to come from that compression in mortgage spreads. That's why we still like that sector. It's up over 8% this year. It's high quality. It's sort of this quasi-government guaranteed, and that's one of the reasons why compounding that 5.25 in yield, and having that high quality, we still think will do well, particularly going into the end of the year as we see more than likely increased volatility.
Right. And how do you get that 10-year yield to go lower? I mean, we've been looking at it around 4% now for a few weeks. Various, 10 basis points up or down. If the Fed keeps cutting rates, can you expect that the 10-year Treasury yield will start to decline and then eventually impact things like mortgage rates?
Yeah, listen, I think the issue has been that, and one of the reasons why we sort of cut some of our interest rate risk in September, the market was already pricing that in.
That's right.
Right? So the market is pricing in the terminal rate around a 2.80 to 3% at the end of 2026, which, by the way, is pushed forward than what the Fed forecast was saying in terms of their SEP projections in September. So the market's pricing that in. How do you get the 10-year yield lower? Well, look, I mean, the obvious answer is growth slows, right? That's one of the reasons why.
Right.
But also, too, I mean, I think that what we're seeing now is, in our opinion, and you know this as well, we expect non-recessionary cuts. So when you have non-recessionary cuts and the market's pricing that in already, you're not going to see these large declines in 10-year Treasury yields because we don't think growth could slow, but we don't think you're going to have a recession, right? So that 10-year Treasury yield is actually going to be quite range-bound. So in order to get that mortgage rate lower, you need to see those spreads compress in the agency MBS market.
Excellent. Leslie, thank you, thank you, thank you. Great to see you.
You too.
Always good to get your insights, and it changes all the time. So not your insights, but the markets. They're just consistently moving and changing, and it's great to have you join us to give us the latest and greatest.
Thank you.
Leslie Falconio from the Chief Investment Office. Thank you for joining us as well. For more information from Leslie and the rest of the CIO, visit our Insights website at ubs.com/views. Plus, you can check us out on social media. UBS is on LinkedIn and Facebook. Plus, you can take a look at our Instagram channel at UBS Trending. Lots of content there for you to take a look at. And as always, if you have any questions about what Leslie and I spoke about today, please make sure that you are chatting with your financial advisor. Until next time, I'm Anthony Pastori. We wish you a great rest of your day, everyone. And remember to keep your eyes on what's trending. We'll see you soon.